Are you still working after age 70 while collecting Social Security? Maybe you are earning more now than you did several years ago. That extra income can be valuable, but it can also create a tax surprise. Many older workers assume that Social Security becomes tax-free once they turn 70. Others worry that earning too much will cause Social Security to reduce or stop their monthly benefits. Both ideas confuse two very different rules. After you reach full retirement age, you can work and earn as much as you want without losing Social Security benefits under the retirement earnings test. But your employment income can still cause part of your Social Security benefits to become taxable. In this video, we will explain how Social Security is taxed after age 70, what up to 85% taxable really means, how to avoid receiving an unexpected tax bill, and the most common mistakes working retirees make. Welcome to the Wealth Pier, where we help adults over 50 protect their retirement income, health, independence, and peace of mind. This video provides general educational information. Tax rules can depend on your filing status, income sources, deductions, and state of residence, so consider consulting a qualified tax professional about your individual situation. Can you work after 70 and collect Social Security? Yes. Once you reach full retirement age, Social Security's retirement earnings limit no longer applies to you. That means you may earn $30,000, $60,000, $100,000 or more from working without Social Security, withholding your retirement benefits because of those earnings. This is true beginning with the month you reach full retirement age. You do not actually need to wait until age 70. For most people now approaching retirement, full retirement age falls somewhere between age 66 and 67. Age 70 is important for another reason. Delayed retirement credits stop accumulating at age 70. There is generally no benefit from delaying your Social Security retirement claim beyond that age. But once you are collecting benefits and have reached full retirement age, wages will not reduce your monthly Social Security payment under the earnings test. However, it does not make your benefits tax-free. There is no age at which Social Security automatically becomes exempt from federal income tax. Whether your benefits are taxable depends primarily on your income and filing status, not your age. The IRS uses a calculation sometimes called combined income. To estimate combined income, take your adjusted gross income plus any tax-exempt interest, plus 1/2 of your annual Social Security benefits. For example, suppose you receive $30,000 in Social Security benefits during the year. Half of that amount is $15,000. You then add that $15,000 to your wages, pension income, retirement account withdrawals, investment income, and other income included in the calculations. The result helps determine whether part of your Social Security is taxable. For a single filer, head of household, or qualifying surviving spouse, benefits may begin becoming taxable when combined income exceeds $25,000. When combined income falls between $25,000 and $34,000, up to 50% of Social Security benefits may be taxable. When combined income exceeds $34,000, up to 85% of benefits may be taxable. For a married couple filing jointly, benefits may begin becoming taxable when combined income exceeds $32,000. Between $32,000 and $44,000, up to 50% of benefits may be taxable. Above $44,000, up to 85% may be taxable. These income thresholds are surprisingly low. A person working full-time after age 70 can cross them quickly. Let us walk through a married couple example. Consider Tom and Linda, both aged 72. Tom works part-time and earns $35,000. Linda is fully retired. Together, they receive $40,000 in annual Social Security benefits. Half of their Social Security is $20,000. Add that to Tom's wages of $35,000, and their combined income is approximately $55,000. For a married couple filing jointly, the upper threshold is $44,000. At $55,000, they are well above that line. That means up to 85% of their Social Security benefits may be included as taxable income. They are still collecting wages and Social Security, but they should not assume their withholding covers the extra tax. Now for a question many retirees forget to ask. Will your state also tax your Social Security? The answer depends on where you live. Currently, 41 states do not tax Social Security benefits. Those states either have no income tax at all or specifically exempt Social Security from taxation. But 9 states, plus the District of Columbia in some cases, may tax Social Security benefits to varying degrees: Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, Rhode Island, Utah, Vermont, and West Virginia. Some of those states follow the same federal thresholds. Others have their own rules. A few states phase out the exemption at higher income levels. Colorado, for example, allows a full deduction for federal taxable Social Security benefits, but only if your federal adjusted gross income is below a specified limit. The important point: federal tax is only half the picture. Check your state's rules before assuming your benefits are completely tax-free. This is one of the most misunderstood Social Security tax rules. When someone says that up to 85% of Social Security may be taxable, it does not mean the IRS takes 85% of your benefit. It means that up to 85% of your Social Security benefits may be included in the taxable income calculation on your federal tax return. Suppose you receive $30,000 in annual Social Security benefits. 85% of $30,000 is $25,500. Depending on your overall income, as much as $25,500 could be treated as taxable income. You would not owe $25,500 in tax. That amount would be combined with your other taxable income. Your deductions, credits, filing status, and applicable tax brackets would then determine the tax you actually owe. At least 15% of Social Security benefits remains excluded from federal taxable income under this calculations. Consider a single 70-year-old who earns $55,000 from a full-time job and receives $30,000 in annual Social Security benefits. Half of the Social Security benefit is $15,000. Adding that to $55,000 of wages produces combined income of approximately $70,000. That is far above the $34,000 upper threshold for a single filer. This person will probably have up to 85% of the Social Security benefit included as taxable income. That does not mean continuing to work is a mistake. The person is still receiving wages and Social Security. But the worker should not assume that normal paycheck withholding automatically covers the additional tax created by the taxable portion of Social Security. That is how an unexpected tax bill can develop. Another surprise for some working seniors is that Social Security and Medicare taxes can still come out of their paychecks. Receiving Social Security does not normally exempt wages from payroll taxes. Employees generally continue paying Social Security tax on covered wages up to the annual wage limit and Medicare tax on covered wages even after reaching full retirement age and beginning benefits. So there are two different tax issues. First, payroll taxes may continue to be withheld from your wages. Second, part of the Social Security benefits you receive may be subject to federal income tax. Those are separate taxes with separate rules. Let us look at some common mistakes working retirees make so you can avoid them. Mistake number 1. Assuming Social Security is automatically tax-free at age 70. As we have covered, there is no age exemption. It is your combined income, not your age, that determines whether your benefits are taxable. Mistake number 2. Ignoring state taxes. You may have researched federal rules thoroughly, but if you live in one of the states that taxes Social Security, the state tax can still surprise you. Mistake number 3. Not adjusting withholding after starting work. Many retirees start a new job or increase their hours, but never update their Form W-4. Their employer continues withholding as if the Social Security income does not exist. That mismatch is how a tax bill arrives in April. Mistake number 4. Assuming tax preparation software will catch everything. Popular software programs ask the right questions, but they rely on you entering accurate information. If you do not realize that working affects the taxation of your benefits, you may not enter the details correctly. Mistake number 5. Cashing out retirement accounts without considering the combined income effect. A large IRA distribution can push your combined income well past the thresholds in a single year, potentially making a much larger portion of your Social Security taxable. The best defense is awareness. Knowing the rules before you file prevents most of these surprises. Now for a more positive note. Continued work may provide one additional advantage. Social Security generally calculates your retirement benefit using your highest 35 years of earnings. Each year, Social Security reviews the earnings records of people who continue working while receiving benefits. If your new earnings replace a lower year among your highest 35 years, Social Security may recalculate your benefit and increase your monthly payment. Here is a clearer example. Suppose you had a few lower earning years in your 30s while you stayed home with children or changed careers. Those years still count in your 35-year average, which pulls your benefit down. If you return to work in your late 60s or early 70s at a higher salary, those current high-earning years can replace those low-earning years in the calculation. Social Security performs this review automatically. So when someone says, "I am earning more each week than I ever have before," those higher earnings could potentially produce a benefit increase. The increase may be modest, especially if the person already had 35 years of strong earnings. But for someone who had gaps or low earning years, the boost can be meaningful. You may not be able to eliminate the tax while continuing to earn substantial income. But you can take steps to avoid being surprised and to stay within safe harbor rules so you never owe a penalty. First, review the federal income tax being withheld from your paycheck. Your employer withholds based on the information you provide on Form W-4. That calculation may not fully account for taxable Social Security, pension income, investment income, or retirement account withdrawals. You can submit a new Form W-4 and request additional withholding from each paycheck. Second, consider federal tax withholding from your Social Security benefits. Form W-4V allows eligible Social Security recipients to request withholding at one of 4 rates: 7%, 10%, 12%, or 22%. Withholding does not reduce your total tax. It helps pay the expected tax gradually during the year instead of leaving a large balance at tax filing time. Third, understand the safe harbor rule for estimated taxes. The IRS will not charge you an underpayment penalty if you pay at least 90% of the current year's tax liability through withholding and estimated payments, or 100% of the prior year's tax liability, or 110% if your adjusted gross income was more than $150,000. For many working retirees, the easiest safe harbor is to look at last year's total tax and ensure your withholding and estimated payments equal at least that amount. If you meet that threshold, you will not owe a penalty, even if you owe additional tax when you file. Fourth, consider quarterly estimated tax payments when withholding from wages and Social Security will not be enough. This can be particularly important when you also receive self-employment income, pension payments, investment income, rental income, or taxable retirement account distributions. Taxpayers age 65 or older may qualify for an additional federal deduction of up to $6,000 per eligible person for tax years 2025 through 2028. However, the deduction begins phasing out at higher income levels. The deduction may reduce taxable income and lower the final tax bill, but it does not eliminate the existing formula that determines whether